I welcome you to the second teaching of month 3, institutional order flow. So today we're going to be talking about algorithmic trading systems. What is institutional order flow? Institutional order flow refers to the total orders or trades that institutional traders, that is the whales of the forex market, place in the market. This is the general understanding of institutional order flow. But my own explanation is it is the handwriting of institutional traders seen in price movement as it seeks liquidity. So by now we should know who institutional traders are. These are people that move the markets, that are the market makers. They are the central banks, the big banks, investment banks. The whales reduce capital with the ability to move price, and they seek liquidity. Liquidity is what gives them efficiency in order to execute their orders. With institutional order flow in play, when price intends to seek liquidity above or below the market, price moves with speed in that direction and shows the unwillingness to go the opposite direction until the intended liquidity is taken. You can trust that price is protected by institutional levels, the order blocks, breaker blocks, etc., from going the opposite direction as it moves towards liquidity. So I'm going to be showing us an example how we can identify the institutional order flow and how we can implement it in our trades. All right, so this is a 3-month time frame chart. It means one candle represents 3 months. I want us to know that price is fractal. Anything I explain here happens in all time frame, even the 1 minute, the 1 second, 30 seconds. It happens in all time frame because price is fractal. We should also be aware that price is not random. It is controlled by an algorithm, like I said in the beginning. Price is controlled by an algorithm that seeks liquidity in order to provide efficiency for the market makers to execute their orders. So we can see price creating a range here. Price moved. There's a price swing. Price moved from this point here to this point, creating an order block. As soon as this low is broken, this becomes an order block. After price ran down, it returned back to the order block. This is a bearish order block, the last up close candle before the down move. So we can see it here. So as price returned here, it found resistance, but then again went deep into this order block. One way to qualify another block is you don't want to see price close above the mean threshold. The mean threshold is the midpoint from the close and open of this candle. We're using the body, we're not using the wicks, just the body. So you measure it with your feet from this close to the open. The midpoint is called the mean threshold. You don't want to see price close above the mean threshold if it is a bearish order block. If it is a bullish order block, you don't want to see price close below the mean threshold. So the mean threshold helps validate the order block. As soon as price closes above the mean threshold, it reduces the probability of this candle here being an order block. But you can see how price respected it. Price closed below the mean threshold of this bearish order block. So as soon as price hit it, but why will price rally upwards to this order block? Because why? There was a huge move. And look at here, you can see these are down close candles, except this one here, you can see here. These are all down close candles. So market seeks to go back to close this fair value gap that was created. Look at how market ran up to close this fair value gap. When you see a down candle, there always should be an up candle. If there is only selling here, market tends to return back to close that gap for a buy. And if there's only buying here, market seeks to come back to close that gap. So you can see how market ran to this bearish order block, closed below the mean threshold of this candle. The market found resistance to rally downward again back to where? Another order block. This is a bullish order block. The last down close candle before the up move. You can see it here clearly. Price found support, closing these gaps it created. So all these candles you can see are all up close candles. They are all buying candles except this one here. So market seek to close back this gap. This range here was closed back. So you can see how market found support in this order block and then rally back up again, finding resistance in this order block to close these gaps. You can see now, mind you, this is a 3-month time frame. Each candle represents 3 months. So you can see how market ran up to close these gaps here that were created. Finding resistance in this bearish order block. After hitting this order block, this bearish order block, market rallied down to clear this liquidity. Now you'll be saying that the candle did not come below this low. I want you to know that institutional traders trade with the bodies of the candle. The wicks are for retail traders. They actually target the bodies of the candle. That's where there's a bulk of liquidity resting below and above the bodies of the candle. The wicks do the damage, but the bodies tell the story. You can see the bodies here. Look at how market ran down to clear the liquidity. There's liquidity below the bodies because why? This is a high time frame. This is a monthly time frame. So institutional traders work with high time frames. They don't work with 1 minute, 2 minute, 3 minute. No, no, no. They work with the high time frames. And you should expect liquidity to be found below the bodies, not just the wick, but the bodies. Look at how market ran down to clear out liquidity. So market seeks liquidity. So market seeks two things, liquidity and fair value. And I've explained fair value from this point here. This is an up close candle to this point here. There was only selling. So this is a fair value gap. Market ran down to find resistance in the order block. This is the point where they stop buying. This order block represents where they bought. So in order for them to unwind the buying they did here, we don't want to ride price to this point to mitigate the buying that occurred here. That is why it is called an order block. Orders were placed here for this market to rally upwards. So they bought into this candle. So, institutional traders, what they do, they play a hedge game. While they're making profit and they are selling, they are manipulating the market in their buying. So they bought here. So a bulk of their volumes were executed here. So in order to unwind their orders here, price has to get to this point for them to take the trade lower for a profit. Now you can see here again, after taking the liquidity, market rallied upwards back towards another order block, a bearish order block, the last up close candle before the down move. You can see that price did not close above the main threshold, and this is where market is currently. So we expect market will run down to clear out the liquidity below these lows that we can see here, or find support in this bullish order block as we can see here. Now all I've illustrated is market doesn't move randomly. Market move is controlled by an algorithm and it seeks liquidity. So we can see market move from this point here downwards, rallied into the range, found resistance in this other block, rallied downwards, find support in this other block, rallied upwards, find resistance in this bearish other block, rallied downwards, take out liquidity, rallied upwards, and it's finding resistance in this bearish order block. So you can see how price continue to move and move and move and move. So there's a pattern at which price moves. So the moment price hits this bearish order block and starts to rally down, order flow is bearish. The moment price finds support in this bullish order block to rally upward, the order flow is bullish. So now let's say you could predict all these moves here. So let's map out our chart. So I mapped it out. This blue shaded area here represents bullish institutional order flow. This red area that I mapped out here represents bearish institutional order flow. So here's a bullish institutional order flow. Here's a bearish institutional order flow. Here's a bullish institutional order flow. Mapping it out from the higher time frame. So let's assume that the moment price ran down this way, you expect price to rally upwards into this bearish order block to close these gaps here. The moment you're able to predict that, you know that price wants to move from here to here, and it's going to be sponsored by the institutional traders. So now let's assume you know that price is going to move from here to here. So what happens is you mark this area as a bullish institutional order flow. So now I'm going to go into the chart to look at this area that I've mapped to see how price moved from this point to this point, from this point to this point, and from here, here, and thereabout. All right, so this is a monthly time frame. We mapped out these blue areas, stating that the institutional order flow here is bullish. And then this red area, that the institutional order flow is bearish. And then same for here, bullish, bearish, bullish. So now let's look at it in lower time frame. That is the monthly time frame. You can look at here how market was ranging. took out liquidity, broke structure to the upside, and then retraced down, forming a bullish order block, the last down candle, the last down close candle before the up move. So market moved to the upside and then retraced back down into the monthly bullish order block. So we expect price to find support here because the institutional order flow is bullish. So you can see again, market rallied upwards to break structure to the upside. So I hope we can see it clearly. Let me enlarge the chart. So you can see this high here. So you can see this high here. Market broke structure to the upside and then found support in this bullish order block here again and then rallied. Fourth panel resistance in the 3-month bearish order block. You can see how price respected the main threshold. Even in the lower time frame, price did not close above the main threshold of the order block. So this area, the institutional order flow is bearish. So you can see how price broke down, took out liquidity to the downside, and then retraced into the fair value gap that was created as market rallied downwards. Price found resistance in this fair value gap and then rallied downwards to take this liquidity. And then you would notice that price will not be respecting the bullish order blocks because why? At this area, this portion here, institutional order flow is bearish. So you can see this order block is supposed to hold price, but price disrespected it. This other block is supposed to hold price, but price disrespected it. Instead, it respected the bearish support and resistance, which is this fair value gap, as we can see here. So price rallied downward to find support in this order block as it seeks to close this range. You can see here, this down close candle was closer by this up close candle. So this area is balanced. And then it left this fair value gap here from this point here to this low of this down close candle. So this is a fair value gap. So market closed it and then found support in this bullish order block, this monthly bullish, 3-month bullish order block. So market rallied upwards, retraced, rallied upwards to break structure, and then retraced back down into a bullish order block, a monthly bullish order block, where when the institutional order flow is bullish. So we can expect that every support will hold and every resistance will give way. Because why? Institutional order flow is bullish. We can see markets finding support in institutional points. So you can see here, market broke structure to the upside, created a bullish order block, a monthly bullish order block, rallied downward, found support, rallied, broke structure to the upside, rallied downward, found support in another bullish order block. You can see how market found support in this bullish order block here. So market rallied upwards, created another bullish order block. This last down close candle before the up move. Market rallied down to find support in the monthly bullish order block before rallying upwards to this 3-month bearish order block, as you can see here. So at this point, the market is what? Bearish, because institutional order flow is bearish. After market rallied downwards to take out liquidity, it rallied into the range it just created, and then rallied to fill in this fair value gap to find resistance in this fair value gap. So you can see how price respected this fair value gap. So you can expect this fair value gap to hold. Why? Because the market institutional order flow is bearish. Why do you say market institutional flow is bearish? Price is at the 3-month bearish order block. So as soon as price hits this 3-month bearish order block, the order flow has changed from what? Bullish to bearish. So you want to go down to a lower time frame to expect the institutional resistance point to hold price from going upwards. You want to see price going downwards, respecting the institutional resistance, like the breaker blocks, the order blocks, the fair value gap, as you can see here pointed out. But if institutional order flow is bullish, you want to see institutional support levels giving price support and preventing price from going in the other direction. So you can see how price was finding support. Every other block you can be buying because why? Order flow is bullish. So we can go on and on and on and on and on. You can see here, market is bearish because institutional order flow is bearish. At this point here, institutional order flow is bullish. So you can see that price is finding support in this monthly bullish order block. Market rallied and then took out the liquidity to this. So here you can see here is a monthly order block as well. I think I should just draw it out. can see how it became a resistance. Once it hit this monthly bearish order block, so we expect that the previous month we printed here should be bearish because institutional order flow has changed from bullish to bearish. So we're still going to go further to lower time frame, that's the weekly time frame, and then see the handwritings of the institutional traders. So you can see here, this blue area here, institutional order flow, is bullish. So you can expect every bullish order block, every bullish breaker block, every bullish fair value gap to hold price from going lower. You want to see them serve as support. So as market rallied upwards, is there any other block here? You can see one here, but price did not get to it. But look at this point here. Price created another block. What happened? Market found support and they rallied, breaking structure to the upside. So from this low to this high, where is the other block? Here. What happened? Price retraced down into this range and then found support in this order block. I don't think I even pointed it out. This here is a weekly order block. And here also, if you go down to the multi-time frame, is a monthly order block. So you can see here, if I pull it out, you see this is a weekly order. But I don't want to make things clumsy with many lines so that it doesn't get confusing for you. So I'll just take it out here. So you can see here that this is a weekly order block. These consecutively down close candles from the bullish order block. Another thing you can also see happening here is that this range, you can see from this low to this high and this point was closed up. There was selling here and buying, but from here there was only buying. So market came to close it. Not only that, market also took out liquidity. So when market is bullish, rather when institutional order flow is bullish, you can expect that when liquidity is taken below the market, price should rally to the upside. So you can see how liquidity was taking here, price rally to the upside. You see these lows. Mind you, this is a weekly time frame. So this you can see this relatively equal lows here. Market took out liquidity, find support in this bullish order block and then rally. So whenever liquidity is taken, you can see here again, this low here, price took out liquidity, rally. So I don't think there's any example here again of any low taken. All right. So you can see this bullish order block here. Market found support, rallied, bullish order block, market found support, rallied, bullish order block, market found support, and rally. You can see that order blocks are holding price from going downward because why? Order flow is bullish. So once price hits this 3-month bearish order block, market becomes bearish. Why? Because the institutional order flow has changed from bullish to bearish. So you can see here, this is a breaker block. Why is it a breaker block? Because price took out the liquidity here before breaking the low. So you can see here, market moved downwards, took out liquidity to the upside, and then broke structure to the downside. So market found support here. Now, this institutional support and resistance will be explained next month, like the breaker block, the order block, fair value gap, and every other thing will be explained. We have what we call the mitigation blocks. So here's a breaker block. Now there was buying done here. In order for them to take out their trade, they have to allow price to return back to where structure was broken in order to mitigate their loss. I'm talking about the institutional traders. So you can see here, as market rallied downward, market created what? A bearish order block. You can see this is a bearish order. Even here at this point is a bearish order block. Market ran down, hit it, rallied downwards, rallied upwards again after creating a bearish order block, found resistance, rallied downwards, taking liquidity to the downside, then rallied upwards again into this range that was created. And this bearish order block, as you can see here, market found resistance, rallied downwards. You can see how price keeps creating order blocks and finding resistance in the order block. Because why? The order flow has changed. Order flow is very important. Understanding the institutional order flow is very important, and we get it from the higher time frame. So you can see the fair value gap that we pointed out in the monthly time frame. So look at how price rallied upwards before rolling downwards with speed, and then the fair value gap price found resistance. So you can see that liquidity was taken here. I told you that when price is bearish, if institutional order flow is bearish, you should expect that when liquidity is taken to the upside, market should rally downwards. So let me expand it so that we see it clearly. So I think I should draw a line. See this high? Liquidity was taken here. Mind you, this is a weekly time frame. So you can see how the liquidity was taken. Just hope it's clear for us enough to see. All right. So as market took our liquidity rally downward, it found support in the 3-month order block that we saw earlier. This is a 3-month order block. So as market found support, it rallied upward to find resistance in where this bearish order block for the last time, and then came back down into this range because it has created a new range. This is the high, this is the low. If you draw out your fib, let's just draw it out. This point here will become equilibrium. So you want to also apply premium and discount to institutional order flows. So you can see here, market rally. Let me just take it out so that it doesn't confuse us. You just know that this point here is equilibrium. The chart is already becoming clumsy. So you can see how price rally upwards to break structure to the upside. So once structure is broken to the upside, it's telling you that price wants to go bullish. And you know that price is hitting a bullish order block in the 3-month time frame at a discount. So you are very, very safe to buy. So you should trust every order block created to protect price from going downwards. So you can see here, after price rallied upwards, here is a monthly order block. But if you look at the weekly time frame, there is another block created here. So you can see how price found support in this order block before rallying upwards. You can see there's liquidity that was taken here. I told you when liquidity is taken, when the order flow is bullish, you should expect price to rally upwards. So look at how liquidity was taken at this point. This area here signifies a bullish institutional order flow. The institutional flow is bullish at this area. So you can see how market took liquidity before rallying, breaking structure to the upside, and the market retreats down into this range, finding support in this bullish order block, these consecutively down close candles. So market rallied upwards and then found support in the fair value gap, as you can see here. After which, price rallied upwards to break structure to the upside, rallied downwards again and found support where bullish order block. So market rallied upwards and then was ranging. You can expect price to range because why? This is equilibrium. So if you draw your fib from here, you see that this point here is equilibrium. Market tends to stall at equilibrium. Another thing to also notice that price is finding support where in the monthly order block. When the institutional order flow is bullish and an institutional support level fails to hold price in a lower time frame, you can expect that price is going down to a higher time frame institutional support level. Let me explain what I mean. Now, what do we see here? This is a bullish order block. This is consecutively down close candle. You add them up. This is 1, 2, 3, 4, 5, 6. 6 consecutively down close candle. They should serve as a support for price to rally upward. But you can see that price failed to find support here. Where do you think price went to? It went to the monthly order block. So when the smaller time frame institutional support level fails, when the order flow is bullish, you can go to a higher time frame to find the institutional support levels. Like you can see here, look at the monthly look at the monthly bullish order block as price found support. Before rallying, as price rallied, you can see here's another bullish order block, price found support, rallied, another bullish order block, price found support, rallied before coming to this point to break through to the upside and then rally upwards. So you can see how price came back down again to this other block to retest it before rallying, found support in other block, rally, found support. So you can be buying every other block that you see. You can be buying it. You can trust that market will find support in the other block because why? The order flow is bullish. So what do we find here? This is a bullish order block. Market found support. Market rallied, broke structure to the upside. What do you find here? Bullish order block. Market found support, rallied and broke structure to the upside. So market did not return back to this bullish order block. Why? Because here is a breaker. This is a breaker block. Because why? Market took out liquidity before breaking structure to the upside. So once market returns back into the range, this down close candle, this up close candle before market took out liquidity is the breaker block. So you can see how market found support in this breaker block, rallied upwards, came back down to find support in what? This bullish order block, this consecutively down close candles. Market rallied upwards again, came back down to find support in this bullish order block here, as you can see, before rallying upwards to find resistance in the 3-month bearish order block, as you can see here. So once he hits this order block, we know that order flow has changed from bullish to bearish. So you can see how market ran down to take out liquidity below the market, before rallying upwards into the range to fill in the fair value gap. So we can go on and on and on and on. Before market found resistance here after filling in this fair value gap, it came back down to clear out the liquidity. Now I told you that the bodies tell the story. So you can see the bodies of this candle here. Market came down to clear out the liquidity below the bodies of these candles. Before what? Before rallying upwards to break structure to the upside. Now we can see market here as the monthly bearish order block. Market is at this point. So we expect market to run downward. We expect the next play to be a bearish institutional order flow because market is at a bearish order block in the monthly time frame. So my emphasis is that when the institutional order flow is bullish, we want to be looking for bullish institutional support levels. And when institutional order flow is bearish, we want to be looking for institutional resistance level for price to find resistance. It's very simple. Remember what I told you that when liquidity is taken to the downside in a bullish institutional order flow, expect price rally upward. So you can see how market took liquidity here. This point here, let me enlarge it. Market took liquidity here, 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 here. Think another place again. If you go down to lower time frame, you discover. Let's just go down to lower time frame. Let's go to the daily time frame. You see lots of liquidity taken. So if you don't understand this, you will just think that market is going down and not know that you are only being set up by the institutional traders. So you see a daily time frame like this market going downwards. This is bearish because this is a daily time frame, mind you. So if you see market going downwards, you would think that, okay, let's continue to go down. You think that let's continue to sell because market is what? Bearish. Meanwhile, market is only returning back down to a what? Weekly order block in a higher time frame. So if you know all these things, you will know how to apply it properly. As soon as market hit the weekly order block, it rallied upward. So you will see market coming down bearish to what? Take out liquidity, finding support where? In this fair value gap. So let's look at another one. So look at how market came back down again. Took out this liquidity here below the market to find what? Support in this weekly order block. You can see how market came back down to take out liquidity to find support where in this monthly order block. See, this is it. So you will just see market range, expand, take out liquidity before expanding again, then range, consolidate, expand, take out liquidity, then rally upwards. Now look at this rally, this huge rally after this huge move because you think the market has formed a trend. You think the market consolidated, broke out of consolidation, and then it's trending. Now look at how market rallied. So we're looking for liquidity runs. So you can see how market ran this liquidity here, ran up, ran liquidity here, ran up. Okay, ran liquidity for. So you can choose to be any type of trader. You can either be a trader that uses the order block, the breakout block, or liquidity run. You can just say whenever you see a liquidity run, when the market is bullish, when order flow is bullish, you want to be buying. You can also say you want to be using fair value gaps. Now, from this low to this high, let's look at the fair value gaps that we can find. Look how market rallied upwards. Look at this point, it's hitting what? A weekly order block. So you can expect market to rally. And then you can also see that structure was broken to the upside with this candle here. Now let me just think I should take this out. I don't know. Let me just take it out so that we see it clearly. See this high. Market broke it to the upside. And this is a daily candle. So you can say once price enter this fair value gap, you'll be buying. So you will buy this day. Now look at this again. This is a fair value gap. Market ran into it. You will buy again to take your profit above this high. Then do you see any fair value gap here? No. Any fair value gap here? No. Till where you see a fair value gap here. So as soon as price return back to this fair value gap, what happens? You buy. Now look at this candle here. There's a fair value gap created. As soon as price gets into this fair value gap, what happens? You buy again. Do you see any fair value gap as price rallies? No. Now, what do you see here again? Fair value gap. As soon as price gets into this point here, what happens? You buy. Same thing here. As soon as price gets to this fair value gap, what happens? You buy. So you can be a trader that uses only fair value gap. Now, let's try other blocks. You may not see much here. So this is what? consolidation, market rallied. But look at one here. This is another block. So price rallied, broke structure to the upside. As soon as price retraced down to this other block, this bullish order block here, this consecutively down close candles, what happens? You buy to take your profit above the market. So you would expect that price will find support in this bullish order block, but price did not. Now there are times you're going to lose. Accept it. There are times it's not, the market is not perfect. So that's why you should have a proper risk management. So you can see this bullish order block here. Price broke to the upside. This candle here, you'll be buying this candle because why it returned to this bullish order block. What confirms this candle to be another block is when the high was broken here. So as it was broken, price returned back because this down move, this week, let me expand it. This week we can see here returned back into the high and the low of this candle here. So this you'll be buying. Now we see another block here again. This here is another block. So as price returned back to it, what happens? You buy. So we can see another block here. This consecutive down close candle, the price returned to it. So let me just draw it out. So as price hits it, what happens? You buy before price gets to this point. So this range here, you'll be buying because you are still from this low to this high. You are still in a bullish order flow. So when you see that this order block does not hold price, you want to go into a higher time frame. So if you go to a higher time frame from a daily to a weekly, you say that there's a weekly order block here. Look at how price found support here. So once price finds support, you want to go back to a daily time frame again and then refine your trade. You can see this consecutively down close candle. Price broke structure to the upside. Here you can see the structure was broken here and here. So as soon as price returns back down, this here is a bullish order block. It's a daily bullish order block. So you expect to buy these days. So you have how many days? 1, 2, 3, 4, 5. 5 days opportunity to buy. So as soon as you buy again, price did will return back to this order block here. Sorry. You can see here, this is a daily bullish order block. Price return back. And then if what you use is a fair value gap, you can see here as a fair value gap, you can be buying here. And if what uses liquidity, you can see that liquidity was taken at the downside here before market rally. If you use this place to use liquidity, so as price takes out this liquidity, you want to be buying as it also found support in this bullish order block here. And then you can see liquidity was taken here. So you can either use order block, fair value gap, or liquidity. You can as well also use breakout. What can you find here? Here. This is a bullish breakout. I'm sure by now we should be able to identify breakers. So this is a bullish breakout. Why? Because market took liquidity to the downside before breaking up. So the last up close candle before taking liquidity becomes the breaker. This is the last up close candle. This is the bullish. It's a bullish breaker. So as soon as price return back to the range, you should find support in this breaker. So these 3 down close candles here, actually it's just this candle here. This candle, the last up close candle before taking out liquidity. So you can see how market returned back to this area here to find support. So you can use breakers. Okay, I don't think there's any other breaker block here again. Here is also a breaker block. This candle here. So let me just highlight it. Okay. I don't think price was able to get to it. Price did not get to it. Okay. Price did not get to it. So we can see another breaker here again. You can see this high. Let me just draw it out. Because price took liquidity to the downside before breaking structure upwards. My network just messed things up. So let me just highlight it again. So we can see here that this is a breaker. So let's just use the bodies. So you can see how price took out liquidity. This is the last up close candle before taking liquidity. Okay, then market broke structure to the upside. Returning back, it should find support here. So we can see as price continues to go high, finding support in institutional support levels. And they say you will find in a bearish order flow. So let's go down to a bearish order flow. You'll see this whole area here. The order flow is bearish. So you can see how price market moved after filling in this fair value gap. You can see here's another block. Market found resistance before closing. So let's see if this other block was, if market closed above the main threshold. So okay, market actually closed above the main threshold. So the probability of this other block holding has actually reduced. So look at another other block market formed. Okay, rally downwards, broke structure to the upside, to the downside, found support, found resistance in this other block before rallying downwards. You can see this huge move. So if you are a liquidity trader, you see, okay, this high liquidity has been taken. So once liquidity is taken, you expect market to rally downwards to take liquidity to the downside. So these candles here, you can see here, they are relatively equal lows and they actually draw liquidity. Remember, I asked you to find and locate this on your chart. So this helps you to train your eyes. So we can go on and on and on and on and on. So what's this candle here? It's a breakout. Why? Because it took market took liquidity to the downside before breaking structure. So if you draw this here, let's see. Oh, my network is very, very bad. So what do we see here? This is what? A bullish breakout block. So you can see how price found support in this bullish breakout block here before rallying. So we can go on and look at this point here. This is a favorable graph. Price found support after finding support where in a monthly bullish order block. So you can see all these bullish order blocks. Market kept coming back down. Here, market found support. Here, market found support. Why? Because the order flow is bullish. So look at this point here. Market found support. Then if you want to be trading liquidity, if the market takes out liquidity here, you'll be what? Buying. Look at this point here. So the major skill now we should have is how to identify when institutional order flow is bullish and when institutional order flow is bearish. So during the course of this mentorship, I'm going to be teaching you how to identify an order flow, if it is bullish or bearish. And as all times, I wish you all good luck and good trading.